For most people, their pain of losing money is a much stronger negative emotion than that joy of making money. So yes, we all want to make money, but even more so, we want to avoid the pain of loss. Quintessential Financial does have kind of a unique story behind it in that 23 years ago, I was blessed with the birth of my 5 children, all at one time. Well, not at one time, spread out over 95 seconds.
95 seconds.
95 seconds, the healthiest quintuplets ever born on record. And because of that, I named my company Quintessential Financial. I got into the business, really, I got the bug for the business when I was 10 years old. My dad had me tracking all of his stocks and charting them from the Sunday Seattle Post-Intelligencer. From that, I acquired a love for math, and I became an engineer. I went to the Air Force Academy, graduated as an aeronautical engineer, did that for 10 years, and then decided to go into make my avocation investing, which I always loved, my profession. So over 25 years ago, I became a licensed financial advisor. John, I find a lot of the younger people have been told so many times, they're young, they can afford to be aggressive, losses won't impact them. But you know what? It's hard to save money. And when a young person loses all that money because they were overly aggressive or didn't understand their investment, they become twice as conservative after that and don't want to take any risk. The strongest group of people that I think benefit from my services are those that are approaching retirement.
Okay.
Because there's a certain dynamic called sequence of returns. And as you're getting close to that retirement point, if your investments that you've been building up over the years, over the decades, if they suddenly get a 20 or 50% drop like we had in 2003 and 2009, that will decimate your ability to retire. So I try to make sure my clients are investments that protect them against that kind of loss while still enabling them to make gains as the market goes up. One of the best success stories that still brings a smile to my face is back in 2008 to 10 when the market went through a 50% drop. That was killer. I was so thankful, though, that most of my clients, I had them invested in structured notes so that their investments only went down about 3% while everyone else was down about 50%. And we actually took advantage of selling those notes. We didn't know it was the bottom of the market, but we sold out when everyone else was down 50%, they were down 3%, and we rolled them into new notes that gave them new protection, but they were able to ride the market back up when the market was up about 20% or more than the following year. So we got the market's gains without experiencing the 50% market drop. When we meet with a new client, we have a series of questions that we go through with them to identify their risk tolerance, but also identify their goals so that we can, if appropriate, we plug that into financial planning software that helps aggregate everything from Social Security and Medicare and health insurance and retirement savings and longevity and children and college, all of that, because it all factors in to how you can save and grow your money and the liquidity of that money for the future. So we do a financial plan. I've learned to help my clients avoid pain while still having the joy of gain in the market is a investment vehicle called structured notes. Now, I got introduced into structured notes in 2005. At first, I thought they were too good to be true, and I thought it was a scam, honestly. And after a year of hearing about them and getting them validated, I became enthralled with them. And that's what allowed me to protect my clients during the 2008 market collapse. It's why I can still invest today with peace of mind, because I know my clients are protected. One of the fun benefits is what I call the bar bragging rights. When the market is going down or up, either one, you can shimmy up to the bar, and when someone comments about the market performance, whatever they say, if it's up or down, odds are with the notes I've got a client into, they can say, yeah, I didn't lose any, or yeah, I made all that gain on the upside, I didn't miss out. And it's kind of a good bar bragging right feeling.
What are some tips that you would give to the average investor?
For the average investor, the first thing is know what their goals are. Liquidity is important, so don't lock up money that you might need this year. Second is understand what you're investing into. And really to do that, you need to find a trusted financial advisor. And there's a lot of good sites for doing that. A CFP is a good place to start, and I am a certified financial planner. You can go to their site. Also check out FINRA, which is the financial regulatory industry, and they have the background on all financial advisors. And you'll see if they have any complaints. I don't have any complaints on mine. After 25 years, that's pretty good. Well, I'd avoid any high-pressure sales pitches, when you get those free dinners, but there's always a lot of pressure to invest now, while the deal's still available. Most deals will still be good next week also. The other thing is it's good to get a second opinion. A lot of times a spouse is your best second opinion, and if you are married, always have your spouse involved, I suggest. And if you don't have that, or even if you want another one, get a trusted family member or other trusted advisor.
Another trusted advisor, somebody to validate
yes.
that this is the right thing.
And I love explaining what we're doing to people, so I welcome that. Most business owners put everything into the business, understandable, but they need to splice off a little bit, 10, 15% that they put into that side account, what we call a retirement account, that not only gives them a tax deduction, so they don't pay as much to Uncle Sam, but it also protects it, because most retirement plans carry federally protected asset protection against creditors. So if something happens to the business, that retirement plan is still protected. So that's number one and the most important, I think. Second one is also to have other insurance. Business owners, if they have a partner, you better have a buy-sell agreement and insurance to fund that buy-sell agreement. Many people have the buy-sell, but nothing to actually fund it. Disability insurance is important, also long-term care insurance, to look at those things. General rule would be always pay yourself first, so put some amount off to the side. The nice thing is the first account most business owners open up retirement account is a SEP IRA, because it's the only one that can be opened up after the fact when they're filing their taxes. And their tax man tells them, oh, you had a great year last year, now let's give 40% of it back to the government. And they say, oh, but you can open a SEP IRA and you can put up to 20% of what you made into that SEP IRA. So I understand most business owners, when they're starting out and they're not yet to that profitable point, they need to have a side reserve account anyway. And one of the best things to use for that side reserve account is a Roth IRA, because they can pull that Roth money out at any time to help them in the business, but at least it's growing tax-free in the meantime. Another top tip for any business owner, two of them actually. One is they need advisors. They need tax advisors. I'm an investment advisor, I help them, but they need a good bookkeeper and accountant so that they know where their numbers are. And the third one, quite frankly, I know this is self-serving to you, but they really do need a coach, because somebody to help them stay accountable to what they say they're going to do and to give them a different perspective, because it's so easy to get tunnel vision as a business owner.
Well, listen, I really appreciate you taking the time to spend a minute with us and share what's going on with you and share those tips for us.
All right, John, it's been a pleasure. Thank you.